Bitcoin is at a turning point. Crypto equities remain volatile. Institutional staking is reshaping risks, and the 4-year cycle may be evolving into something new. In this video, I'll break down what these shifts mean for investors and how they fit into the bigger global adoption trend. Alright, so let's start off with the first one on how his research analyst firm Van Eyck are evaluating public equities involvement in the crypto space from an investment angle. Now, why I've selected this part of the interview is because this is something that we are going to see an awful lot. If we just cast our minds back where we've come from in terms of the first related crypto ETFs, we all know the Bitcoin spot ETFs were the first set of crypto ETFs that's been approved in the United States financial markets back in January 2024, where 11 Bitcoin spot ETFs have been approved by the financial regulator and have been operating ever since. In fact, it is dubbed as the US largest ETF product, not just crypto ETF, largest ETF product in history in the shortest time it's taken to reach that milestone. So immediately following the Bitcoin spot ETFs, we have Ethereum spot ETFs, which has been recently approved early this year, 2025. So those are the two first crypto specific ETFs. Now, given the actual incoming Trump administration and his favorable pro-crypto gurus in his team, even the SEC chair that's been appointed by Trump, I think his name is Paul Atkins, if I'm not mistaken, again, he's a pro-crypto, completely has taken a 180-degree view from his predecessor, Gary Gensler. So ever since the arrival of the Trump administration and the two preceding crypto ETFs that I mentioned before, the Bitcoin and Ethereum spot ETFs, have actually channeled more types of different type of crypto ETFs. Now we're hearing things like Solana ETFs, which is what Van Eyck is specifically talked about in the interview, which I'll draw in next. There is other types of ETFs like XRP ETFs. And now there's, in addition to those two, we're seeing crypto ETFs. So all of these smaller crypto tokens are going to be basketed into a much broader crypto ETF. So what am I trying to say here is, for the first time in history, we are starting to see the unraveling of crypto-related ETF products included as another type of financial investment vehicle for investors drawing their capital into these crypto-specific ETF products, which we have never seen before. And this is all kudos to Bitcoin and Ethereum spot ETFs. So that is why Matt is now starting to spearhead Solana ETFs, and how he explains there is a lot of volatility, particularly on the more broader spectrum of crypto assets. Remember, there are over 10,000 crypto tokens, right? So it's no surprise at all that the younger the crypto asset, the higher volatility and the higher rate of risk in terms of risk-adjusted returns that investors are expected to receive whenever they invest in these type of crypto tokens or crypto assets. And particularly for companies or pension fund providers, they need to be very wary about it, because these financial companies who are going to be investing on their clients' behalf in these crypto-related ETFs, which is what Van Eyck is going to be doing, is most of these are leveraged investment players. What do I mean by leveraged? I mean, companies usually don't use their own corporate treasury reserve assets or cash or tangible assets in order to finance their operation. What they tend to do is they borrow, and this is what we mean by leveraging. The higher the leverage, the more toxic are those drawdowns in times of trouble or in times of high volatility in the marketplace. So we need to, from a retail standpoint, I've always advocated in my channel, which is all the more reason why you need to subscribe to learn more about the videos that I regularly publish. We need to avoid leveraging. We need to avoid borrowing capital to invest in crypto particularly, and that includes also Bitcoin. So what his company Van Eyck are doing is, he's witnessed there is a huge demand now for capital inflows into these basketed crypto-related ETF products. He's mentioned over 150 companies, public equity companies, are now actively monetizing digital assets, from Coinbase and Bullish, which are examples of crypto-related exchanges, to infrastructure like electricity, and equipment providers. And actually, I just came back from a trip from Iceland where I did a private guided tour for a whole week on the vast amount of abundant energy resource supply that I've seen throughout the island. Anything that ranges from glacier cooling energy, geysers, geothermal energy, and the fosses, the waterfalls that actually generate the hydroelectricity. And I have explained that those are the three key examples where Bitcoin miners can tap into those abundant energy resource supply of their mining of their new Bitcoins, which again provides ultimate a knock-on effect, a benefit for us investors, because the more miners are involved in the mining operations of new Bitcoins, the more resilient the network and the more secure it becomes. So that is the dichotomy explanation I've given in that episode, which I encourage you to watch. So going back to this segue, there is more public equity companies now investing into these crypto related ETF products, and the sentiment is rather bullish in that respect. So the exposure to crypto equities isn't just Coinbase or miners anymore. It's a mixed bag between pure plays and mainstream corporates integrating stablecoins worldwide, which is another important area. If you remember, again, I made a ton of videos on the dependency on stablecoins, bringing that fiat capital from the physical and analog world into the digital realm. So we should never discard the importance of stablecoins and why we should be using stablecoins as an indicator out of many to determine how much of that capital inflows is generally coming into the digital realm, into the digital economy and in crypto. So that's that segue. Now, just a short break as a reminder, if you're finding this episode adding value, make sure notifications are enabled. We cover Bitcoin, blockchain technology, and real world assets without the noise and the hype. So stay informed and stay ahead. Now, let's get back into today's episode. Segue. Let's move on to the next interesting segue on his views on the latest on crypto staking. Now, he made a mention that from an institutional staking perspective has actually arrived. Now, in the case of his firm, his research analyst firm, Van Eyck, Solana ETS may directly integrate staking, which lowers the friction and professionalizing validator operations. He also made a warning on risk. In the case of the US, they're starting to lower the risk if there are onshore validators brought back into the US to be involved in validating transactions, because offshore validators once seemed safer, but now US-based validators may actually be more secure under a new regulatory framework. Remember the Clarity Act that I mentioned in a few of my videos? That is the only critical crypto bill in the US that is left outstanding to be approved. So from an investor warning perspective, there are many altcoins that have high inflation rates, and if you're not staking, you're being diluted. That's what he said. Staking just maintains your share, not true yield. So for me, the two critical risks still remains. There are still a counterparty risk. What do I mean by a counterparty risk? Again, I've explained this in many of my videos. It's a centralized authority or a centralized entity that controls the actual equities that they manage under a management firm, under a management team, their own agenda, their own P&L, where there is a company CEO that heads this management infrastructure, this company. That is a counterparty, and the counterparty risk will always remain in that respect. So we need to be mindful that you need to do that research, and I have given clues in the past where the obvious one for me would have to be ensuring that these institutional players that are providing these crypto staking operations to investors, you need to ensure that they've been approved by the local financial regulator, i.e. they've received a license in order to be able to offer these crypto staking operations to their clients. Because without that, if, let's say, heaven forbid, you're unable to withdraw the coins that you've deposited in these crypto staking platforms in any moment in time, or even withdrawing some of the gains that you might have received, or earning interest and receiving the interest payments as a result of loaning and depositing your crypto holdings in these crypto staking platforms, well, you won't have the recourse to go to the financial ombudsman or the financial arbitrator for consumer rights protection. to be able to support and retrieve any potential wrongdoings from these crypto staking platform operators. This is, for me, is such an easy thing that investors can just do the legwork and just satisfy that these platform operators, these staking platform operators, are licensed by the local financial regulator. I can't emphasize that enough. And the other part of the risk is, he's mentioned it, dilution risk. What do I mean by dilution risk? Remember, there's an awful lot of pump and dump schemes that we've seen throughout the last few years in the crypto industry. We've got the FTX. You need to be very wary about it because the dilution risk is real. Any crypto firm that has its native token, they can overinflate the supply at any moment in time. Ethereum is no different because it's run by a security. And again, what do I mean by security? I mean a management team, company CEO, there is a P&L, and there is a ledger that they are accountable, and particularly if they're a publicly registered company, they need to be able to provide and report out every quarter the state of their financial standing to its regulator. Right, so that is a security. Every crypto firm that has a team in place is by default a security, and they control the rules of engagement in terms of how much they overinflate the supply or the issuance of coins, crypto tokens. So that is, for me, the biggest risk, dilution risk, and also counterparty risk. So these two areas you need to really take into consideration when you're starting to evaluate what are the trustworthy crypto staking platform operators, where I like to get that yield, because some of the tokens, particularly Bitcoin, this is the handicap that we currently have. We are unable to generate yield as a result of depositing our Bitcoin holdings, let's say, under a cold wallet arrangement. So again, you need to be very wary about that, to not fall into the trap of losing your coins because there is some fancy like yield proposition provided by a crypto staking platform. So I can't emphasize enough, counterparty risk, dilution risk needs to be part of your evaluation. So whenever you evaluate potential prospective crypto staking platform operators that provide too good to be true, that is a red flag. But you need to do that research. What Van Eyck has explained here, it might be illegitimate, but nevertheless there's still a counterparty risk. And the dilution risk still remains, because even though they don't directly control the Solana ETFs, the actual Solana issuance of the tokens are not controlled by them or the ETF, but actually by Solana as a crypto native blockchain operator. They can issue any amount of Solana tokens at will. That is the issue of a security, because they can make that decision, which they are not answerable to anyone, right, other than themselves. That's the point. So that's an important segue that I want to bring to your attention. And then this brings to my last part of the discussion around whether we have reached the end of this 4-year market cycle for Bitcoin. Now, Matt's view here is rather cautious. He feels that this 4-year cycle likely continues, but he feels it's muted. Why? Because of the emergence of the ETFs that's been approved. We've got increasing demand and adoption by sovereigns, corporations, buying into Bitcoin to smooth out extreme volatility. Even that from a political arena, the political cycle effect in terms of the midterms, macro policy stagnation may slow down somewhat the momentum, but the ETFs and the sovereign adoption could counterbalance. So I think I have to agree with him on that. The 4-year cycle, I feel, is coming to an end, but it's muted. I think we're coming towards, we're in a transitional phase where we are in between what was once the conventional traditional 4-year cycle for Bitcoin and coming into a post 4-year cycle. So what would that look like in my view? It could be longer bull cycles with much sharper corrections or drawdowns. Because as I explained again in a few of my videos, if you take the example of Bitcoin, it's a $2 trillion plus asset class. And with increasing amount of capital inflows brought into the network, what you're going to be seeing is the widening of the capital base. So no matter the drawdowns, the selling, the manipulation, the speculation that will occur over time, the rate of which that speculation or the selling takes place over a prolonged growing capital base underneath, is going to have such a small effect, thereby reducing the rate of volatility as a result. So what I'm trying to say is we're going to be seeing sharper corrections in a much smaller time frame window and a much prolonged bull cycle. That's, for me, is what I would expect to see as the brand new post 4-year cycle will look like for Bitcoin. That's all I have for you for today. If you value clarity on Bitcoin, blockchain technology, and real-world assets tokenization, stay alert. Subscribe and enable all notifications to stay ahead of the curve. Share this episode with those who need to understand what's coming, friends, family, and colleagues. This channel aims to deliver insight, no noise, and no hype. Subscribe now.